I'm going to go ahead and read the wording that Kim asked us to read. Sessions will be recorded for future reference. Your participation indicates your consent for your voice or your image to be part of the recording. Please do not disclose any private information during the sessions. And again, I'll just say one last time, make sure that you've opened up your code word and survey fill out form. And it looks like it's 2:55 and we'll go ahead and get started. So I am Carrie Dugan-Brubaker and I've been a member of the team here at Hantzman Weeble for 13 years. And my other team member, Faye Perillo, will be providing information as well. All right, what is new for 2021? Faye, it's the K2 and K3. And I agree with Ted, strange things are afoot at the Schedule K. So let's get started. What are these new forms? What's going on? So the K2 form adds foreign transaction details to Schedule K, Form 1065, 1120S, and Form 8865, which is the return of U.S. persons with respect to certain foreign partnerships. And the K3 adds the additional foreign detail to the K1. These new forms, in theory, were created to provide more clarity for shareholders and partners on how to calculate their U.S. income tax liability when considering potential international related deductions, credits, and miscellaneous items. Although these forms contain a new level of detail, most of this information was already required to be included on Schedule K1 using the code 16, using line 16 and the 31 codes associated with line 16, as well as the footnotes and attachments. But no longer. So for 2021, we've got these two forms. The K2 is 19 pages, and the K3 is 15 pages. The new international related schedules are required to be filed for all 2021 partnership, S-corp, and S-corp returns. You're only required to fill out the relevant portions of the new form, and all amounts should be reported in US dollars unless otherwise specified. These are significant changes, but fear not. The IRS is merciful, and they recognize that the detailed new schedules will create transitional challenges. So they've announced in Notice 2021-39 that it will require certain penalty relief, or it will provide certain penalty relief to filers who fall short of the new requirements that start in 2021, as long as they've made a good faith effort to comply. They've filled out what they thought was correct, maybe missed some things, but the IRS is going to provide relief for any penalties associated with that. Currently on the IRS website, both forms are still in draft form. And according to the IRS website, the modernized e-file extensible markup language electronic capability, which means they're coding for what can be, for allowing things to be e-filed. For the schedule K2 and K3 is not going to be available until March 20th of 2022 for the 1065, mid-June of 2022 for the 1120Ss, and January of 2023 for Form 8865. So what does that mean? If you want to electronically file your return before those timeframes, the recommendation is to submit the schedules as separate PDF files attached to the return. And the IRS is going to have recommended standard naming for those PDF files, which are going to be posted to the irs.gov site. They're not currently there. So with all these new changes and all that in mind, and as we know from Ed's Ethics CPE, not all CPAs are going to follow all the rules. So just as a thought, I would definitely caution you to carefully look through the K-1 statements for this transitional year, because some people may just continue to do it the way that they've done it previously. And what we're going to do as we go through some of the forms, we're going to show you how things were filed previously, so you know kind of what to look for when you're looking through those schedules and attachments on the K-1, as well as where it should be reported on the new forms. So any questions so far about this?
Carrie, I was just wondering if you could repeat those dates when they will release those things.
Yes, absolutely. So March 20th of 2022, they should have the coding set up to electronically file the K2 and K3 for Form 1065. Then for Form 1120S, they should have it ready for electronically filing by mid-June of 2022. And then for the 8865, not until January of 2023.
So we still need to file them this way, but it's not automatic through our software where we can electronically file these new K2 and K3s. We're going to have to print them to PDF, is my understanding,
That is correct.
and
Mhm.
attach them. There's like a coding, a name convention that the IRS will, I guess, provide
Recommend.
soon.
Uh-huh.
And then if we do it that way, if we miss a few pages or we answer some boxes wrong, they're going to forgive us.
That's right. You
Okay.
got it.
All right. So,
Or at least that's what they're saying.
okay. So do you want me to show the examples now?
Um,
Uh,
sure.
I mean the
Or
K2 and K3.
yeah, that'd be fine.
So David also said, oh, or is asking, so basically we're extending every pass-through entity that has a foreign activity. I
Um,
wish, but
uh, right. And I imagine we're gonna get forms later maybe than even we usually do. We'll just have to see how things play out. All right.
so
So Faye is gonna kind of scroll through the K2 and the K3, and I'm gonna explain to you what kind of information you're gonna find on each part. So for parts 1 through 3 and part 8, that's where the information related to completing the form 1116 and 1118 for your foreign tax credits and to calculate your foreign tax credit limitations are going to be found on, again, that's part 1 through 3, as well as part 8 is going to be those foreign tax credit information pieces. And then Faye, if you would share bookmark 3, I'll show this form is going to show you how it was reported in prior years. So in prior years, you can see there on line 16, using the codes, they're providing information. And then if you go down to the next page, Faye, information that didn't have enough space on the line 16 was reported as a statement to the K1. So in theory, with this new form, you would not you would not have that information there. Then we go to, so part 4 of the Schedule K, K2 and K3. That's where the information to prepare 8993, which is the Section 250 deduction for foreign derived tangible income and global intangible low taxed income, otherwise known as GILTI. Part 5 of the form is going to enable eligible partners to exclude previously taxed income and to report the currency gain or losses related to PTEP income on eligible partners. Part 6 of the form provides information to prepare the 8992 for U.S. shareholders' calculation of GILTI. Part 7 of the form is going to provide the information needed to complete your Form 8621 unless the partnership filed on behalf of the partners. So, Faye, if you open up bookmark number 5. Thank you. So, this is an example of a K1 we received in the supplemental information from 2020. And for this 8621, which is your PFIC information, what I had said before was that unless it's been filed on behalf of the partners. So in this case, on this form, the statement actually says the partnership has already filed on your behalf and you don't need to do an additional filing. And so I'm not sure as to how that'll present on the K2, K3, or if there will still be a statement like this attached to the K1. We just have to wait and see, but definitely make sure we're looking through those, any statements and attachments to those K1s for proper reporting. Anyone have any questions so far? Nope. All right. So next, we've got the K2, K3, still a lot of unanswered questions, still waiting for the final form. So the next thing we wanted to do is review some of the forms that we commonly use and see, and explain the requirements for filing those forms.
Carrie, can I add
Yes.
something a little bit about the K3?
Yes.
I think the way I understand this, so the K2 is actually part of like the return itself, right?
Correct.
It's
The
like okay,
K2 is additional information for the Schedule K
right,
on the 1065s,
right.
1120Ss,
And then
8865s.
and then the K3 is kind of the on the K1s, they're going to be like included at the back
It's
portion
the
of it.
partner share of the information
That was
reported
in the
on the
K2.
K2. That's
Okay,
correct.
awesome.
Thank
Any
you.
other questions? All right.
All right, should we move on to the exciting world of 8938 and 114 FBAR requirements? So these are all of these foreign reporting forms have severe penalties. So you really want to ask good questions, make sure you understand what your clients have, um, and report it correctly. So the 8938 and the 114 FBAR, while some of these forms are used to disclose ownership, signature authority, and signature authority of foreign financial accounts, the thresholds for filing and who must file differ with these forms as well as the filing authority who receives and processes the forms. So Form 8938 is filed with the IRS, while Form 114 is filed directly with the Office of Financial Crimes Enforcement Network, which is a bureau of the Department of Treasury. Who is required to file the 8938? U.S. citizens, resident aliens, certain non-resident aliens, domestic corporations, partnerships, and trusts. Some of those same people are also required to file the 114, the U.S. citizens, resident aliens, trusts, estates, and domestic entities that have an interest in foreign financial accounts, resident aliens of U.S. territories, and U.S. territory entities are subject to the FBAR reporting requirements. So when do you have an interest in a foreign financial account or asset that requires reporting? For the purposes of the 8938, any foreign transaction that would be required to be reported, included, or otherwise reflected on your income tax return, and the taxpayer meets the filing thresholds. For the FBAR, you must report accounts that have a financial interest in or signator authority on and meet the filing thresholds. So the filing thresholds for the 8938, they vary depending on your individual filing status, where the individual is living, US or abroad, and for specific domestic entities. And those are here on the slide as far as what the threshold amounts are for filing. For the FBAR, it is required when the aggregate value of financial accounts exceeds $10,000 at any time during the calendar year. With both of the forms, you're going to report the maximum value of the account during the year. So you're not just looking at the value at the end of the year. If they do have an account, you need to find out what the highest value was. And the accounts are valued using whatever that maximum value is. And if that's in foreign currency, then you're going to use the US dollar exchange rate at the end of the taxable year. And I've got a chart at bookmark 9, Faye. Okay, so this chart can be found, and it's published by the Treasury Department. And if you Google Treasury reporting rates of exchange historical, or something like that, it will come up. And you can also go to fiscal.treasury.gov to get this information, and it lists every foreign currency, and they publish it quarterly. So in this case, in the presentation, I pulled up the December 31, 2020, so you could see what it looks like. Any questions on that? All righty. So we're going to go back to the slide deck. The due dates for both of these forms are the same as the individual tax returns, and you can also get extensions just as you would for the regular return. The penalties are tough, as you can see here. Which is why it's critical to ask questions if clients aren't answering the questions in the organizer, going back to the partner or the client and confirming with them that they don't have a foreign account or have signing authority on a foreign account. And as always, you can certainly ask Glenn. I mean, he's your best choice, but Glenn, myself, Faye, or Josh make up our international tax team. And if we don't know the answer, we'll certainly do our best to find the answer for you. We're going to show our first code word of the day, which is hola. And now I'm going to turn the presentation over to Faye.
All
So again,
right.
that code word is hola, Hola.
Thank you, Carrie. I just also wanted to add that the a lot of common mistakes we find when we see 8938 filings is that, you know, we are alerted when we see like bank accounts or investment accounts, but there are other types of financial interests and other types of foreign assets that a client may have, like a pension account, a life insurance account, and we need to ask about those things too. And they could also be included on the 8938 filing to be alert on those things. All right, let's continue with other commonly filed foreign tax forms. I'm going to talk about the 5471. And we do see a few of these in our practice. So this is the information return of U.S. persons with respect to certain foreign corporations. Um, so this is used by certain U.S. persons who are officers, directors, or shareholders in certain foreign corporations. This form and schedules are used to satisfy the reporting requirements of sections 6038 and 6046 and the related regulations, as well as to report amounts related to section 965. So we are supposed to attach form 5471 to income tax returns of these persons, but there are certain categories of filers. If you've seen this form before, we wanted to alert you that there were current changes on the category of filers. By the way, you could also be a partnership or an exempt organization and have a need to file the 5471. One example that I'm going to share with you is we have a small nonprofit client who files like a 990, and then, you know, in one of their transactions, we found out that they actually needed to file a 5471 because they transferred or they contributed some money to a foreign country to help out with some nonprofit tax exempt programs out there in a different country. Let's just say the country was Guatemala. Well, we found out that in order to do that program in that country, they had to go through a corporation, and a corporation had to be established in Guatemala. And so now that puts the nonprofit entity in a relationship with this foreign corporation, and thus it triggered the need to file a 5471. So that's what we had to do for it. Was within the 990 we had to attach this 5471. And I mentioned earlier that there are new categories of filers. So it used to be just a few categories in there in the previous versions of the 5471, and now we have category 1 broken further into category 1A, 1B, and 1C. So these are U.S. persons who own 10% or more of the total combined voting power of all classes of voting stock of a specified foreign corporation. And then you have your category 2. So we also see a lot of this in our practice where we have a U.S. person, a U.S. citizen or resident who is an officer or a director of a foreign corporation that meets the 10% stock ownership requirement. And then you have category 3, a U.S. person who acquires stock in a foreign corporation which, when added to any stock owned on the date of acquisition, meets the 10% stock ownership requirements. You have category 4, a U.S. person who had control of a foreign corporation during the annual accounting period. And another change this year is for category 5, they broke this down further to 5A, 5B, and 5C. So I also wanted to emphasize that depending on which category filer you end up being, there are different schedules that are required for different types of category filers. So these are also new for this year. And just be on the lookout for that one. Okay. Penalties. There is a 10,000 penalty imposed for each annual accounting period of each foreign corporation for failure to furnish required information. And if the information is not filed within 90 days after the IRS mailed the notice of failure, so they'll add more to that, you'll have additional 10,000 penalty with a limit of 50,000 for each failure. So pretty high stakes in here. Okay. The next form I wanted to talk about. Oh, okay. Glenn has his hand raised. Glenn?
Can you hear me?
Yes.
So I just wanted to point out with regard to the penalties, going back to the F-bar penalties. There was a case in the Ninth Circuit earlier this year where the court ruled that the F-bar penalty applied on a per form basis. So if you had half a dozen foreign accounts reported on the F-bar, there'd be only one $10,000 penalty. But the Fifth Circuit just very recently ruled that the penalty applied on a per account basis. So, meaning if you had 6 foreign accounts on an F-bar, you had 6 penalties. And so obviously there's a conflict between the circuits, which is going to have to be decided, I guess, presumably by the Supreme Court at some point. But if you think about it, penalty on each account. Well, we've got some clients that have a half dozen different foreign accounts. So it is a something we definitely need to pay attention to.
Glenn, is that just for the F-bar?
That's the F-bar, yeah.
But that does not apply to what I mentioned earlier, like if you had an 8938 and you're missing one of the assets in there.
I don't think these cases address the 8938. I think it was only the F-bar.
So it's per account.
Yeah. Well, in the Fifth Circuit, it's per account. In the Ninth Circuit, in the Fifth Circuit is I think it's Texas, Mississippi, and Louisiana or something like that. The Ninth Circuit is out west, like California.
Thank you, Glenn. All right, so for the Form 5472, this is the information return of a 25% foreign-owned U.S. corporation or a foreign corporation engaged in a U.S. trade or business. So this form is used to provide required information on reportable transactions of a reporting corporation with a foreign or domestic related party. So a reporting corporation is either a 25% foreign-owned U.S. corporation or a foreign corporation engaged in a trade or business within the United States. So this form is filed by the corporation, the U.S. corporation on the return due date. Okay. So if you have a U.S. corporation with at least one direct or indirect 25% shareholder at any time during the tax year, you need to file this form, and you need to report all intercompany transactions between the U.S. reporting company and all related foreign persons. You need to file a separate form for each 25% foreign shareholder. Okay. Penalties also pretty steep. We have 25,000 penalty that will be assessed on any reporting corporation that fails to file this form when it is due. And if you're filing a substantially incomplete form 5472, that also constitutes a failure to file the form. And if the failure continues for more than 90 days after notification, you will get an additional 25,000 penalty. So let's go and file these forms. All right.
Okay, next up, we have the form 8858. And what this form is information return for U.S. persons with respect to foreign disregarded entities and foreign branches. This form is used by U.S. persons that operate a foreign branch or own a foreign disregarded entity directly, indirectly, or constructively. And where I have used this form and seen it most often with our client base is when we have a taxpayer that has a rental property abroad. We see, and it's owned by a single member, therefore it's going to be held in LLC, disregarded entity. That's where we see it. So when we get information on rental income, look at that address, make sure that that address is not a foreign address. And if it is, ask some more questions, get more information, because we do need to file that 8858 for reporting the income or losses on a rental property overseas. Let's see here. As with all of the foreign information filings, as we've already said a bunch of times, the penalties are steep. For this one, the penalty for not reporting the income on the 8858 is $10,000 per year of not filing. Then, if the IRS finds out about it and sends you a notice that you don't respond to within 90 days, they will assess another $10,000 penalty per 30 days, up to a maximum of $50,000 for each year. So if you haven't filed it for many years, for multiple years, they're going to hit you for each year. So really important to pay attention to addresses, asking good questions, getting the information about if there is a foreign rental property. Glenn, have you used that form for other reporting items for our client base?
I'm sorry, you're talking about the 8858?
Yes.
Well, as you said, mostly it's, we have clients that have rental property, offshore.
Mm-hmm.
But it could be any trade or business or rental property, and it doesn't have to be in an entity. I mean, if you own it, I've got a client that personally owns a rental property in the UK. That's still considered a foreign branch.
Okay. Great. Thank you. All right. So then moving on to the 8865, which is the return for U.S. persons with respect to certain foreign partnerships. The Form 8865 is used to report information about controlled foreign partners, transfers to foreign partnerships, as well as acquisitions, dispositions, and changes in foreign partnership interests. Starting in 2021, the new K3 should provide all the information needed for reporting on Form 8865. And if we go to bookmark 7, Faye. All right, so you see there on this K1 from 2021, there's information. There's an example of how the information was presented in prior years in the footnotes. So I think for this, we need to look at those K3s, also look at any statements and attachments to see what kind of information is being provided and make sure that we are filing it. Thank you for that, Faye. So, U.S. persons qualifying under the following categories you see here are all required to file an 8865. The penalties for not filing are the same as with the 8858. So that 10,000 per year, and then if you receive a notice and don't file within 90 days, again, 10,000 per year up to a max of 50,000. I'm going to turn this back over to Faye.
All right, so I am going to talk briefly about Form 1116, which I'm sure all of you have seen. Who should file? Individuals, trusts, estates with foreign taxes paid to a foreign country or U.S. possession. Individuals may elect to claim the credit, and most of you already know this, without filing the form itself if all foreign income is passive category income. All the income and any foreign taxes paid on it were reported to you in a qualified pay statement, which include the Form 1099 Div, 1099 Interest, Schedule K1, or a similar statement. Total creditable foreign taxes aren't more than 300 or 600 if married filing a joint return. All right. And so, similar form, but this one is for corporations, is the Form 1118. So this form is used to compute a corporation's foreign tax credit for certain taxes paid to foreign countries or U.S. possessions. So any corporation that elects the benefits of the foreign tax credit under Section 901 must complete this 1118 form and attach it to its tax return. Now, towards the end later, and we kind of just touched on this, although this is a very familiar form to you, is because there are upcoming changes that they're proposing as part of the international tax reform, international tax reform that's upcoming, and one of these changes has to do with a foreign tax credit. So I'm going to touch on that later on and what they're trying to do, what they're trying to change on the foreign tax credit. All right, so let us go to our second code word, which is bonjour. I think we heard that in our first session this morning. All right, that was very short, but I will turn you back to Carrie.
All right, so next up, we've got the Form 926, which is the return by U.S. transferor of property to a foreign corporation. So this form is used to report U.S. citizen or residents, domestic corporations, or a domestic estate or trust who, after a transfer, the U.S. transferor holds 10% or more of the total voting power or value of the entity, or the amount of the cash transferred in a, oh, okay, sorry. David had something in the chat there. Okay, I've lost my track. We'll start over. So the form is used to report U.S. citizens, residents, domestic corporations, or a domestic estate or trust who, after a transfer, the U.S. transferor holds 10% or more of the total voting power or total value, or the amount of the cash transferred in a 12-month period exceeds $100,000. Penalties for not filing this are very high, and they can be as high as $100,000. So you want to be sure to review those K1 footnotes. And Faye, if you could please pull up bookmark 16. So I'm going to show you an example of the way I see this disclosed quite often in the attachments to a K1. What the partnership does is it provides you a list of all the transfers done throughout the year, and then you have to apply the ownership percentage of your partner to those totals. So Faye, if you would scroll down on this slide or on this PDF. So, oh, yeah. So there you go. Yeah, so you can see there we've run a tape of the total of all the transfers, multiplied it by the percentage ownership of the partner to determine if we have a filing requirement or not. So you do want to take the time to do that and make sure that you are under filing thresholds.
Right, because, sorry,
Go ahead,
I was
Faye.
just going to say that like a common mistake I've seen is that you see the amount of the transfer and then you're like, oh, it's over a certain amount, or you end up with a certain percentage and then it's over 10% and then you forget, or we forget to multiply it with your ownership. So
Correct. Right, good point, Faye. Thank you. And the last form I'm going to talk about today is the 2555, which is the foreign earned income exclusion. So if a taxpayer is working overseas and meets both the tax home test and either the bona fide residence test or the physical presence test, they can exclude foreign earned income up to $108,700 for 2021, and that exclusion amount is adjusted annually. And when getting information from a client as far as determining if they've met the tests appropriately, is to be sure to ask them about travel that they've done away from their host country and how long have they been in the U.S. For vacations, that type of thing, to be sure that they qualify for this exclusion. So Faye, you're going to take us home.
I wanted to add that, and I might want to ask Glenn about this one. I kind of read that there is a waiver that happened when COVID hit, because there were some instances where so some people were like, they had to go somewhere outside of their country, or they couldn't go back to their country, and then they end up failing the 330 days that they had to be in their country for their foreign income to be excluded. And I kind of read that because of COVID, it's kind of it was unnatural. It was not ordinary. So the IRS granted a waiver on that requirement, but I don't know if that's ended. So I wanted to see if
Yeah, I think so. And the only real exception to the uh, to the 330 days, if you're trying to qualify under the physical presence test, is if you had to leave the country because of a war or something of that nature.
Okay.
and then so that one was kind of just added in there for a period of time because it was like a war against COVID, right? At that time, you're fleeing the
Yeah.
war.
And while I'm got my unmuted, the foreign earned income exclusion really works best when your taxpayer is in a low tax country, because you have the option of the foreign earned income or the foreign tax credit. And if you're in a high tax country, the foreign tax credit works sometimes even better.
Right.
Right.
Thank you, Glenn.
All right. So we have the following resources. If you have questions about international tax, we have access to BNA International. We do get like notices through email about the changes in different countries. We have compiled a chart for foreign reporting forms that we commonly see in our practice, and you're welcome to look at that. That was actually included in the individual like a guidebook or the individual memo book that we have and put together, so you can look at that. We probably need to update some things within those specific forms, but it's there. And finally, you could come to and ask us some questions, ask the international team right now. um, G- Glenn, it's Glenn, Carrie, myself, and Josh. And I think Glenn has his hand up.
Yeah. So also, aside from our team here, as as the firm is a member of the Allineal Global Association, we have a network. There is an international tax committee and various working groups in that committee. When we put together a pretty good network of contacts worldwide that we can
Yes.
draw on, when we need assistance from other countries, and uh, that we can refer clients to, and they sometimes refer to us.
Right. So if you ever have clients or people you know personally who have questions about different countries and their dealings with these different countries, please reach out to us. If we aren't able to give you an answer, we do have connections, we have contacts, and we can research for them or connect them with these people from different countries. And so hopefully we can serve them in that manner as well. All right. The third code word is shalom. And then we will end, because we have 2 minutes left, with looking forward to 2022 and beyond. So these are the proposed international tax changes that we're supposed to see 2022 and beyond. So they are trying to um, have some changes implemented on the GILTI. So basically, what they're trying to do is to increase the effective tax rate for the income that you are supposed to include through GILTI by reducing the allowable deduction, and thus you're increasing the effective rate for your GILTI income that you include. And then the other change for that is where now you're able to consolidate your income from that's a GILTI income from different countries. You're able to consolidate when you do your calculation. They're trying to do it country by country. Maybe they'll get more tax out of people if it's done that way. And then they're going to try to repeal or modify the deemed 10% QBAI return, which is actually a reduction when you try to calculate how much of the income, guilty income, is going to be included and taxed. So when they take that out, then guess what? You might be taxed more. So foreign tax credit changes, they're going to try to do country by country basis when you report it within each separate limitation category. And the other change that might happen is the foreign tax credit carryback is going to be eliminated, and the carry forward is going to be limited to 5 years versus 10 years. So that's upcoming. And other foreign tax credit update, where you used to be able to use the foreign tax credit to offset NII for your NII tax calculation. They're trying to get that to not be included, or you can no longer use that. And they're trying to see if they can have, to not allow foreign tax credit on digital services tax. So those are the things that we're going to see in the future. With that, we are wrapping up this session unless anybody else has other questions. We are right at 3:45. Thank you so much. I know we are on the home stretch and we have one more set of sessions, and oh, there is something in here. All right. Well, thank you so much and
Thank
have
you,
a
guys.
good evening.